Hedge funds don't invest the way most high-income earners do. In fact, if your portfolio is mostly index funds, stocks, and maybe some real estate, you're investing very differently than institutional capital. And here's the surprising part. Most hedge funds are not trying to beat the market. They're trying to survive crashes better than you, because avoiding a 40% drawdown is often more powerful than chasing an extra 10% gain. Today, I'm breaking down how hedge fund allocation strategies actually work, why multi-strategy hedge funds structure capital the way they do, and what parts of that institutional asset allocation model high-income investors can realistically apply. And by the end, you'll understand why traditional diversification is often an illusion. Let's start with the biggest misconception. Most investors think diversification means owning different assets, stocks, bonds, real estate. But during real market stress, those assets often move together. That's because they're driven by the same dominant force: economic growth and liquidity. Hedge fund allocation strategies don't start with asset labels. They start with return drivers. Where is return coming from? What risk factor is dominant? And how does this behave in a crisis? That's a completely different framework. Here's the first major hedge fund allocation strategy: long, short equity. But not the way it's usually explained. Most people think this just means buying good companies and shorting bad ones. That's incomplete. The real objective is controlling net exposure. If a fund is 100% long and 70% short, its net exposure is only 30%. That means it's not betting primarily on the market, it's betting on skill. This is one of the core hedge fund allocation strategies used in institutional portfolio construction. Now here's why that matters. If markets fall 25%, a long-only investor absorbs the full impact. A properly structured long-short allocation may experience far less volatility. It's not about aggression, it's about engineering the return stream, and that theme continues. Now here's where hedge fund allocation strategies become more interesting. Global macro funds don't focus on individual companies. They allocate capital based on structural economic shifts. Interest rates rising, they adjust duration exposure. Inflation building, they allocate toward real assets. Currency divergence, they position across global markets. These positions are not dependent on corporate earnings. Macro returns can be positive, while equities are negative. That's not traditional diversification. That's differentiated exposure. If your entire portfolio depends on equity growth, you're exposed to one primary driver. Multi-strategy hedge funds deliberately build multiple independent drivers. That structural layering reduces fragility. Another important hedge fund portfolio structure is event-driven allocation. These strategies focus on specific corporate catalysts: mergers, restructurings, spin-offs. If a company is being acquired at $50 but trades at $47, funds analyze the probability of deal completion and capture the spread. That return isn't based on optimism. It's based on probability and structure. Again, a different return engine, and combining multiple engines is the entire point of institutional capital allocation. Before we go further, here's the important shift. Hedge fund allocation strategies are not about complexity. They're about controlling what destroys wealth. Most investors don't fail because they lack upside. They fail because of concentrated downside. In the next section, I'll show you what high-income investors can actually apply from this capital allocation framework without needing institutional access. This is where it becomes practical. The largest hedge funds operate as multi-strategy platforms. They allocate dynamically. If volatility rises, exposure shifts. If spreads widen, allocation increases. If opportunity declines, capital pulls back. Traditional portfolios are static. Institutional asset allocation is adaptive. Capital flows toward opportunity and away from concentration. That flexibility is the real structural advantage. Most individuals cannot directly access top-tier multi-strategy hedge funds, but you can apply the philosophy. 3 principles matter. First, reduce single-source dependency. If your net worth rises and falls with one index, you are concentrated, not diversified. Second, add differentiated return streams where appropriate, not more of the same exposure, different exposure. Third, think in risk factors. Instead of asking, "What should I buy?" ask, "What risk factor am I overexposed to?" When you study hedge fund allocation strategies, you'll notice they prioritize risk-adjusted returns over raw performance. That shift alone elevates portfolio construction. Here's something most investors underestimate. If you lose 40%, you need a 67% gain just to recover. Hedge fund portfolio structures are built around avoiding severe drawdowns. Not because they avoid risk, but because smooth compounding wins. Many hedge funds don't dramatically outperform the S&P in bull markets. They aim to outperform during stress. Because protecting capital accelerates long-term compounding. That's the institutional mindset. The biggest misconception about hedge fund allocation strategies is that they're mysterious. They're not. They're structured. Multiple independent return streams, dynamic capital movement, intentional risk control. For high-income investors, adopting that framework may be more powerful than accessing any specific fund. If you want a deeper breakdown of how family offices and institutional investors structure portfolios differently from retail investors, subscribe, because that's what we're covering next.